In your portfolio, large cap funds would surely provide a good stability and less volatility. But for better returns, you always need funds with a steroid, that is, small cap funds in your portfolio. So in today's video, we will discuss about one more popular small cap fund, that is Axis Small Cap Fund, and check its performance using real data. And by the end of the video, we shall be able to decide whether one should invest in this fund, or if invested, should continue our investment in this fund or should exit this fund now. And if decide to exit, then which fund to go with. So please watch the video till the end. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. This video is my second video on Axis Small Cap Fund. I had made earlier video on 27th March 2022. Link is attached in the I button and also in the description. You can please check the same from there. To start with, we all know that Axis Small Cap Fund has been one of the star performers in its category, that is small cap category. Here we will be taking into consideration data of direct plans only. First, let's look at the basic details like AUM, that is total asset under management, which is around 11,000 crores, which is a little bit higher for a small cap fund. I will talk about this in the later part of the video about the risk associated with high AUM. While the expense ratio is 0.52%, that is around 0.5%, and is low as compared to other schemes. The benchmark index, that is the reference against which the scheme is compared, is Nifty Small Cap 250 TRI. So now let's look at the sector-wise allocation. From the table, it is very clear that the fund is heavily invested in chemicals, followed by healthcare, finance, technology, and construction. Chemicals being the evergreen sector, while healthcare and finance being core sectors, and quite a good performing small size companies form a part of this sector, and when compared to its benchmark, its allocation is quite different. Now let's look at the top holdings and portfolio allocation. As evident, Galaxy Surfactants and Fine Organics are the main stocks of the chemical sector, whereas Narayana Hrudayalaya and Krishna Institute of Medical Science are from healthcare sector, whereas Birlasoft is from the technology sector. Here also the stock selection looks good. On checking the portfolio allocation, it is evident that the small cap shares form around 40% of the portfolio, whereas mid cap shares form other 58% of the portfolio, and only negligible 2.20% is allocated to large cap stocks. With above allocation, the fund is able to provide a good downside protection during bad phase, and also be able to generate a good return with less risk. The portfolio allocation is quite good and very suitable for long to medium term investors. If you have also observed, presently the fund is having debt allocation of around 18%, which is quite high looking at the market conditions. This high debt holding can adversely affect the fund's performance. Now let's look at the fund manager. Mr. Anupam Tiwari has been managing the fund since October 2016, and that too very efficiently, and hope that he continues in future also. Here this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's see how the fund performs on risk parameters. Here we compare the parameters with the benchmark index and category average. First, mean return, that is the average return in a year, which is 28.19, which is slightly more than the benchmark index, but quite less than the category average. Here, higher the value is better. Second, standard deviation. That is a tool to measure how much the return has deviated away from the mean return, which in this case is 23.73 and is also less than both the benchmark index and the category average. Here, lower the value is better. Third, Sharpe ratio. That is a tool to measure the risk adjusted return, which is 1.04, which is more than the benchmark index and same as the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to the benchmark, which is 0.76, which is less than the category average. Here, lower the value is better. Fifth, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 5.87, which is less than the category average. Hence, from the above table, it can be concluded the fund's performance is slightly better than the benchmark index, but when compared to the category average, it is quite underperforming. Now let's also check the trailing returns. So on comparing the trailing returns for 7 years, 5 years, 3 years, 1 year and less, it is all the time able to beat the benchmark index. But when compared to the category average, it is a mix of hit and miss. For some periods, it is able to beat, and for some period, it is not able to beat. Hence, for this inconsistency in performance, let's also check the calendar returns. On checking the calendar returns for the last 8 years, that is from 2014 to 2021, the fund has not been that consistent in performance. That is, in the year 2014, 15 and 16, it had outperformed the benchmark but was not able to beat the category average. Whereas in 2017, it underperformed both the category and benchmark. In 2018, it can be said that it outperformed both the benchmark and category as it dropped less than both. Again, in 2019, it outperformed both, but 2020 and 2021, it again underperformed. Hence, it can be concluded that the fund is not consistent in its performance, and most of the time it is not able to beat the category average, which is not a good sign for a fund. Now let's also check the calendar returns for this year, that is 2022. On checking the first 2 quarters, the fund has fallen less than both its category and benchmark. But in the third quarter, when there is a positive returns, it is not able to beat its category and benchmark. Hence, can be concluded that the fund has a better downside protection, but it is not able to outperform when the market rises. So now let's also check the rolling returns. Here we will check the rolling returns for 5 years, 3 years and 1 year. Here also the performance of rolling return is quite good for 5 years. As compared to the benchmark, it has been able to beat the benchmark 100% for 5 years period. Whereas for 3 years period, it is 94% and for 1 year, it is 73%. Surely, if you only compare the performance of the fund with its benchmark, then the fund's performance is quite good. But things change when we compare it with the category average, that is, with the other funds in the category. From the rolling returns, it can be concluded that with a longer time horizon, the fund is performing better. Hence, one should have an investment horizon of 7 years and more. Now let's see the upside, downside capture ratios and risk return graph. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 84, which indicates that the fund underperformed 16% more than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index had dropped. Here, the value is 73, which indicates that the fund declined 73% as compared to the index during this fall period. Here, lower the value is better. The downside capture ratio is good, but the upside capture ratio is quite poor, which is also quite visible in the calendar returns, where the fund has fallen less than the category and benchmark, but it is not able to outperform its category and benchmark during the rise period. Now let's see the risk return graph. Here on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that the fund has better total returns value with higher standard deviation as compared to the benchmark index, but lesser total returns with less standard deviation as compared to the category average, which indicates that the fund has been able to generate better returns with high volatility as compared to the benchmark index. So now coming to the conclusion, what investors should do. Before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel to watch such interesting videos in future also. So now let's look what investors should do. First, the existing investors. From the data, what we have seen till now, it is very clear that the fund's performance is better than its benchmark index, but is lagging when compared to its category average, that is, other schemes in the category. Hence, I feel that looking at the excellent past performance of the scheme and no change in the scheme attribute and fund manager, one should wait for at least a quarter or two and see how the fund performs. Good performing mutual funds tend to underperform sometimes, so just wait for some more time and then take any decision. The consolation here is that still it is better performing than its benchmark, so surely one should give a try for at least 1 or 2 quarters. But do keep a close watch on its performance and its competitors' performance. Second, for the new investors, the whole purpose of investing in small cap fund is generating better returns with a little more risk. Hence, in that case, instead of starting investment in this scheme, one can look for schemes from Canara Robeco or even Nippon and SBI. One may feel that the AUM of Nippon and SBI small cap funds is on a little more higher side, but not going by absolute AUM figures. If you see in relation to the overall market size, it is okay, and a steady increase in AUM can be managed by the fund manager, which is evident in their performance. To keep the increase in AUM under check, SBI and even Nippon does not allow lump sum investment in their small cap schemes. One can also opt for Canara Robeco as there are no restrictions and its performance is also quite good. I would like to add that I do not have excess small cap fund in my portfolio and also not planning to invest in it. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you.